Hi everyone, Mark Lichtenfeld, your Chief Income Strategist with the Oxford Club. Welcome to State of the Market. And if you haven't subscribed to this channel yet, go ahead and click that subscribe button, and that way you'll never miss a State of the Market video. You know, there is more than $100 billion invested in the top 5 largest bond mutual funds. That's $100 billion too much. Not because PIMCO, Vanguard, and Fidelity don't have quality funds, they do, but because the only reason you should be in a bond mutual fund is if you don't think interest rates are going higher in the future. And if that's the case, you and me are going to have to fight. And trust me, you don't want any part of that. Sorry, I get a little worked up about interest rates. But in all seriousness, you should only be invested in bond funds if you think rock bottom interest rates are here to stay. Otherwise, if rates move up, you will lose money in a bond fund. Let me repeat that because it's important. If rates rise, you will lose money in a bond fund. Now, I'm not opposed to owning bonds, quite the contrary. I think most investors should own individual bonds, but not bond funds. Now, here's why. When you own an individual bond, you get paid a fixed rate of interest, and at maturity, you receive $1,000 back per bond. If you paid $1,000 for it, that means you get your capital back. If you paid $950, you make a little bit of money on top of the interest because you get back $1,000. If you paid $1,050, then you lose $50, but usually the interest you received over the years more than makes up for it. But basically, except for the case of bankruptcy, you get $1,000 back at maturity. Now, a bond fund is very different. When you invest in a bond fund, the price is based on the net asset value, or NAV. Now, this is the value of all of its bonds. When rates go up, the value of bonds fall. And it makes sense when you think about it. If you can buy a bond with a 4.5% interest rate, when the 10-year Treasury is yielding at 1.5%, you're getting a 3% premium to invest in a bond rather than what is considered the safest investment in the world, that Treasury. If the 10-year Treasury rises to 3%, then a 3% premium would equal 6%. But if you're holding a bond that pays 4.5%, when current bonds are paying 6%, that 4.5% bond will fall in price. So if you own the individual bond, that doesn't matter because you can hold it to maturity and get the $1,000 back regardless of the price of the bond at any time while you hold it, you still get the $1,000 at maturity. But if you own the bond fund, the lower price of the bond will cause the NAV to fall. And bond funds don't have maturity dates where you can collect your $1,000 back. When you sell a bond fund, you get the NAV. And if rates are up and the prices of its bonds are down, the NAV falls and you lose money. It is practically guaranteed to happen in a rising rate environment. That's why if you believe rates are going to rise, as I do, get out of your bond funds. If you want exposure to bonds, find some individual bonds to own so that you get your $1,000 back at maturity no matter how high interest rates climb. And by the way, everything I've talked about today regarding bond mutual funds goes for bond ETFs as well. For more information on buying individual bonds, just click on my free presentation below. Thanks for watching State of the Market. I'm Mark Lichtenfeld. I'll see you next week.